The good news is very simple. You can fix the most dangerous leaks without genius. Close the door on high fees. Close the door on frantic trading. Close the door on blind faith in the latest hot thing. Do that and you'll own your future. Do that and decades from now you'll thank yourself for the patience you showed today. If you walk away from this message with one promise to keep, let it be this. Make your plan. Keep it inexpensive and let time, your quiet, tireless partner, do its work. Every few years, Wall Street reinvents the same old trap. It just gives it a fancier name. They'll tell you about private opportunities, exclusive access, or alternative strategies that only the smartest investors understand. But here's the truth they'll never say out loud. When you can't see what you own, you're the product, not the investor. The moment your money disappears into something you can't easily value, can't easily sell, and can't clearly understand, you've already lost the game. You just don't know it yet. Every investor dreams of growth, but very few realize how quietly the enemy of that growth operates. Costs don't come knocking at your door like a market crash or a recession. They slip in silently every single day, cutting a small slice from what's rightfully yours. Over the years, those small bites turn into enormous sums. The truth is simple. The less you pay, the more you keep. But in the noise of flashy funds, clever marketing, and short-term promises, people forget that costs are the most reliable destroyer of long-term wealth. You can't predict the market. You can't know which sector will rise or which will fall. But you can't know with absolute certainty how much you're paying. That's the one variable in your control. The difference between a fund charging 0.1% and one charging 1% may sound trivial today, but stretch it over 30 or 40 years and you'll find yourself giving away nearly half your gains, not to the market, not to fate, but to fees. Think about that. Half your future gone because of a line buried deep in the fine print. Wall Street has built an empire on this very ignorance. It thrives on the investor's blindness to arithmetic. It knows most people chase performance charts, not expense ratios. It knows investors are emotional and impatient, looking for the next hot hand to beat the market. But here's the harsh truth. The average fund manager doesn't beat the market after costs. The moment you pay for management, trading, and distribution, your odds of outperforming fall dramatically. Costs are certain, outperformance is not. Yet investors continue to pay for hope when discipline costs nothing. Imagine two investors starting with the same $100,000. One invests in a low-cost index fund charging 0.05%, the other in an active fund charging 1%. Assume both earn the same gross market return of 7% annually. After 40 years, the low-cost investor ends up with roughly 1.40H. The high-cost investor, around $1.7 million. That's over $400,000 gone. Not to bad luck, not to poor choices, but to a simple, relentless math equation. That's the tyranny of compounding costs. They work against you in the same powerful way that compounding returns work for you. And yet, the industry will keep inventing new ways to make costs look invisible. Performance fees, wrap fees, platform fees, turnover costs, and tax inefficiencies. They're hidden under layers of jargon, and the investor rarely sees the full picture. You might think you're paying 1%, but when you factor in trading costs, marketing, and the drag of high turnover, it could easily be double that. Every dollar spent on fees is a dollar that could have compounded for you instead of lining someone else's pocket. Investing should be about ownership, not speculation. It should serve the investor, not the middleman. When you buy a share of a fund, you're not just buying an asset, you're entering into a long-term relationship. And like any relationship, you should know what you're giving and what you're getting. If that relationship takes more from you than it gives back, it's time to walk away. The beauty of focusing on costs is that it demands no prediction, no special insight. You don't have to forecast the economy, time the next crash, or guess which stock will explode. You simply keep more of what you earn. The arithmetic doesn't lie. The more the industry takes, the less you keep. And over decades, that difference defines whether you retire with comfort or regret. So the message is plain. Costs matter. They always have, and they always will. They are the only part of investing that is both certain and controllable. Every investor who ignores this truth becomes a donor to the financial industry. Every investor who honors it becomes an owner of their future. Investing at its core is not about brilliance, It's about discipline. It's about doing what works, keeping what's yours, and refusing to surrender your wealth to unnecessary expense. The math of investing is simple, but only if you have the courage to see it clearly. The biggest illusion in the investment world is that you can outsmart time. The idea that if you just buy at the right moment and sell before the fall, you can beat the market and retire rich. It's a seductive fantasy, one that fills brokerage ads, dominates TV shows, and fuels every get-rich-quick story that circulates at dinner tables. But reality doesn't bend to emotion. The market does not whisper its next move to anyone. The truth is, market timing and trading churn are the quiet assassins of wealth. They give investors the illusion of control while steadily draining their future. Over the years, countless investors have tried to catch the wave. They buy after the market has surged, convinced they've found the next trend, and they sell after panic sets in, thinking they're saving themselves from disaster. Human nature, we chase what feels safe and flee what feels scary. But in investing, emotion is the exact opposite of logic. By the time a move feels comfortable, it's usually too late. History shows that missing even a handful of the market's best days can destroy decades of growth. Studies repeatedly reveal that most of the market's long-term gains are made in a few unpredictable bursts, days no one can forecast. If you're out of the market when those days arrive, you're out of luck and you can never get them back. Trading churn, the constant buying and selling, only makes things worse. Every time you trade, you pay in commissions, in taxes, in spreads, and in emotional exhaustion. The more you act, the less you own. Compounding works best when left undisturbed, yet most investors sabotage it by constantly interrupting it. The very act of doing less, holding steady through thick and thin, is what allows compounding to do its magic. The patience doesn't sell. It doesn't feel heroic. It doesn't make headlines. So investors keep trading, keep guessing, keep hoping to be right next time, and in doing so, they become victims of their own activity. There's a paradox here. The market rewards patience, but tempts you toward action. Every news headline screams urgency. Every chart you see flashes a signal. Now is the time. But no one has ever consistently and accurately predicted when now truly is. The professionals with the biggest computers and the deepest data struggle to do it. If they can't, why would the ordinary investor think they can? The tragedy is that trying to time the market feels responsible. It feels like you're protecting your money. But in truth, you're stepping in and out of a moving train, losing your seat every time you jump. The most successful investors aren't those who guess right about recessions or rallies. They're the ones who built a plan, stuck to it, and refused to flinch when the crowd panicked. They understood that time in the market is far more powerful than timing the market. Compounding doesn't depend on luck, it depends on endurance. The years you spend invested, not the days you try to dodge, are what build wealth. Every moment you spend wondering when to sell or when to buy is time you could spend simply holding, reinvesting, and letting patience do the work. Real investing isn't entertainment. It's not about excitement. It's about ownership and consistency. The less you trade, the more you gain. The longer you hold, the more compounding rewards you. So when the next wave of panic hits, and it will remind yourself of this, volatility is the price you pay for long-term growth. Don't try to sidestep it. Don't believe you can outdance the market's rhythm. The people who win this game are not the ones who move the fastest, but the ones who stand firm the longest. Every trade you skip, every urge to act now, you resist, is a victory for your future self. The market doesn't need your predictions. It needs your patience. The discipline to stay the course when others can't is what separates the investor who keeps wealth from the one who keeps chasing it. The market is not your greatest enemy. Your own mind is. Every chart, every headline, every whisper of fear or greed in the financial world finds its target not in the numbers, but in the investor's psychology. The truth is, investors don't lose to the market. They lose to themselves. They make decisions not based on logic, but on emotion. And that's where wealth quietly slips away. People like to believe they're rational when it comes to money. They think that with enough news, data, and charts, they'll make smart choices. But investing has never been about information. It's about temperament. The best data in the world won't help you if you panic when the market falls or get greedy when it rises. The average investor's returns are often far lower than the market's returns, not because of poor funds, but because of poor behavior. We buy when we feel good, and we sell when we're afraid. In doing so, we reverse the formula for success. Fear and greed are ancient forces hardwired into us for survival, not for investing. When danger approaches, humans react. But markets reward the opposite instinct. When everyone is afraid, opportunities appear. When everyone is euphoric, danger is near. The ability to act contrary to emotion, to buy when there's blood in the streets, and hold when the crowd is losing its head, is what separates the disciplined investor from the desperate one. Yet very few have the courage to stand alone when emotion takes over. Behavioral biases have many faces. Overconfidence tells us we can outsmart the market. Loss aversion tells us to sell at the first sign of trouble. Recency bias makes us believe that whatever happened last week will happen again next week. Herd behavior makes us follow the crowd into bubbles and stampedes out of crashes. Confirmation bias ensures we only read and believe opinions that agree with what we already want to hear. And each of these tiny psychological traps works quietly and visibly until you find yourself wondering why your portfolio never matches the performance you expected. Technology has only amplified the problem. With trading apps in every pocket and financial headlines updating by the minute, investors now have more opportunities than ever to make bad decisions. The market's short-term noise screams louder than its long-term wisdom. Every dip feels like disaster, every rise feels like a revolution, and every investor feels compelled to do something. But successful investing is about doing less, not more. It's about setting rules so you don't have to rely on mood. It's about building a system that protects you from your worst impulses. The best investors are not the ones with the sharpest intellect, they're the ones with the steadiest temperament. They don't let the latest news decide their next move. They don't allow greed to dictate buying or fear to dictate selling. They know that markets move in cycles, but emotions move in waves, sudden, powerful, and irrational. They understand that discipline is a skill, not a feeling. It's the ability to act the same way when everyone else is losing their minds. If you want to succeed, you must first learn to manage yourself. We need to accept that you will feel fear, greed, and doubt, and that these feelings are signals to pause, not to act. The market doesn't punish ignorance nearly as much as it punishes impatience. It's not the bear market that ruins portfolios, it's the panic that follows it. The great irony is that every investor already knows what to do: buy low, sell high, stay long-term, minimize costs, but very few actually do it. Why? Because the hardest work in investing isn't analytical, it's emotional. The battle isn't fought in financial statements, but in the human heart. You win by mastering yourself. So when the market swings and your emotions start shouting, remember this simple rule: the market isn't your enemy. Your impatience is. Your fear is. Your greed is. The day you stop trying to outguess the market and start learning to outlast your own emotions, that's the day you truly become an investor. One of the greatest misconceptions in modern investing is the belief that owning many stocks automatically means being diversified. On paper, it looks that way: dozens or even hundreds of holdings spread across sectors, industries, and countries. But dig a little deeper and you'll often find that what looks like broad exposure is in truth a house built on a few pillars. False diversification is one of the quietest dangers an investor faces today, and it's become even more pronounced in an era where a handful of giant companies dominate the market's performance. When you own an index fund or a portfolio that mirrors the market, it's easy to assume safety through variety. But when the top 5 or 6 names account for a third of the total return, you're not as diversified as you think. You've become, perhaps without realizing it, deeply tied to the fate of a few dominant corporations. If they stumble, your portfolio feels it. And when the crowd piles into the same few winners, concentration risk silently replaces the comfort of true diversification. Real diversification isn't about how many names you hold, it's about how much influence each one has. Owning 1,000 companies doesn't protect you if most of your wealth rises and falls with the same small group. It's the difference between variety and balance. Variety gives the illusion of safety. Balance delivers the reality of it. Investors often forget that the goal of diversification isn't just to capture growth, but to protect against the unknown. You diversify because you accept that you can't predict which sectors or companies will lead the next decade. History offers a clear warning. In the late 1990s, investors were convinced technology stocks would dominate forever. Portfolios stuffed with diverse tech names seemed safe until they weren't. The same pattern has replayed in every era: railroads, energy, finance, housing, and now mega-cap technology. Each time the story is the same. Investors convince themselves that a few giants are invincible, that this time is different, but no company, no matter how mighty, is immune to the cycles of competition, regulation, or human error. The market always reminds us, eventually, that leadership rotates and concentration punishes those who forget. Another subtle form of false diversification comes from owning multiple funds that overlap. Investors think they're spreading risk by buying several different ETFs or mutual funds, but many of them hold the same top names. The overlap gives the illusion of diversification while compounding exposure to the same stocks. You can easily end up paying more fees for the same holdings, believing you've reduced risk when you've actually increased it. True diversification means spreading your bets across different asset classes, sectors, and geographies, but it also means understanding what you own. It's not enough to hold a list of tickers. You must know the weight each carries. You don't have to own everything, but you must avoid putting your financial future on the shoulders of a few stars, no matter how bright they shine. There's another layer to this issue: emotional concentration. When everyone's talking about the same companies, it's hard not to believe you're missing out if you're not heavily invested in them. The crowd feels safe, and safety feels profitable, but crowds rarely build wealth. They chase it. When valuations stretch and expectations reach the sky, concentration becomes a trap disguised as opportunity. The more the market revolves around a few names, the more fragile it becomes. The antidote, as always, is balance and humility. Accept that you can't predict which parts of the market will lead the future. Accept that spreading risk may limit your upside in booming times, but will save you from devastation when the tide turns. Real diversification means owning the world as it is, not as you wish it to be. It means protecting yourself from your own optimism. So look at your portfolio with clear eyes. Ask yourself not how many names you own, but how dependent you are on a few. Because the danger isn't in owning too little, it's in thinking you own enough when, in reality, you're standing on a narrow foundation. Diversification isn't decoration, it's defense. And it's the quiet, steady defense that allows investors to stay in the game long after the latest darlings fade. In every generation, the investment world finds new ways to make old mistakes look exciting. When markets feel uncertain and the promise of steady returns fades, investors begin looking for something different, something exclusive, sophisticated, or alternative. The financial industry knows this well. It dresses up complexity in elegant language, gives it a new name, and sells it as innovation. Today, that disguise comes in the form of illiquid or exotic products and a new obsession with private markets. They sound appealing. They promise higher returns, diversification, and access to opportunities once reserved for the elite. But behind the marketing, the truth rarely changes. Complexity costs money, opacity hides risk, and the ordinary investor ends up holding the bag. There's nothing inherently wrong with innovation in finance. The problem begins when investors forget what makes investing work in the first place: transparency, liquidity, and discipline. Public markets have these qualities. Prices are visible, costs are clear. You can enter and exit with minimal friction. But when you move into illiquid products, private equity, hedge funds, structured notes, or non-traded real estate vehicles, those safeguards fade. You can't always see what you own. You can't always sell when you want to, and you almost never see the true costs. Illiquidity is often marketed as a virtue, as if locking up your money makes you a smarter investor. The pitch goes like this: because you can't withdraw, you'll stay invested longer, and that discipline will pay off. But forced discipline is not the same as wise discipline. There's a difference between holding because you believe in your plan and holding because you're trapped. The reality is that many of these products offer limited redemption windows, high minimums, and complex fee structures. They benefit the managers who collect steady fees regardless of performance, not the investors who bear the risk. Then there's the private market hype, the idea that the best opportunities have moved away from public exchanges, that real wealth now hides behind closed doors. It's an alluring narrative, especially when traditional markets look volatile or slow. But what most people forget is that private markets are private for a reason. They lack transparency, are harder to value, and depend heavily on optimistic assumptions. When times are good, reported returns look smooth and attractive, but that smoothness is often just an illusion created by the absence of daily pricing. The true test of any asset is how it behaves under pressure, and in private markets that truth arrives late, sometimes years late. Investors are drawn to exclusivity. Being part of something special feels powerful. But the moment an investment relies on exclusivity to sell itself, it deserves skepticism. The best opportunities in the long run are rarely the ones hidden behind lock and key. They're the ones available to everyone, simple, transparent, low cost, and liquid. Those don't need glamour because they stand on mathematics, not marketing. There's also a moral dimension to this. Every dollar an investor commits to a product they don't fully understand strengthens a system that profits from confusion. The financial industry thrives when people chase what they can't clearly see. But the real victory for an investor is clarity, knowing exactly where their money goes, how much it costs, and what risks they're taking. Transparency is not boring, it's protection. Liquidity is not weakness, it's freedom. If an investment promises to be different, exclusive, or insulated from the market, take a step back. Ask what you're giving up for that promise. Are you trading simplicity for complexity, liquidity for illusion, control for dependency? The markets have always rewarded patience and punished pride. The more sophisticated a product sounds, the more skeptical you should become. In the end, investing is not about chasing novelty. It's about owning what you understand and keeping what you earn. The surest path to long-term success isn't hidden behind private gates or exotic structures. It's out in the open, available to anyone disciplined enough to ignore the noise. The future belongs to those who don't fall for every new trick the market invents. The investor who chooses clarity over complexity, patience over promises, and transparency over temptation is the one who will still be standing when the hype fades and the truth, as it always does, comes to light. The good news is very simple. You can fix the most dangerous leaks without genius. Close the door on high fees. Close the door on frantic trading. Close the door on blind faith in the latest hot thing. Do that, and you'll own your future. Do that, and decades from now, you'll thank yourself for the patience you showed today. If you walk away from this message with one promise to keep, let it be this. Make your plan, keep it inexpensive, and let time, your quiet, tireless partner, do its work.